Let's stay there because U.S. Treasury Secretary Janet Yellen says China has failed to address the unfair trade practices that trigger U.S. tariff hikes on the country. Now, she spoke exclusively with Bloomberg's Anne-Marie Horndern.
We're undergoing a 4-year required review of tariffs. We have to see what comes out of the 4-year review. But I would emphasize that really the underlying concerns we have not yet been addressed, and we need to work on that going forward.
Need to work on that going forward. So here now to discuss the risks of doing business with and investing in China is Milken Insitute Chief Economist Bill Lee. Bill, always good to speak with you. Romaine mentioned the weak Chinese data. We also have worsening tensions with the U.S. as highlighted by Yellen's remarks. How do the tepid growth metrics on China obscure what's actually happening inside the country?
I think the numbers themselves belie the fact that there are vulnerabilities in China that really haven't been addressed for quite a while. The widening income and wage gaps are showing up big time because most of the rising middle class is holding their wealth in property market, and the property market is in complete disarray. No one knows where their wealth is going. And then the youth unemployment. The children of these middle class consumers are not getting jobs. So there you have family income and family wealth completely going down the doldrums. So it's not surprising that the post-COVID recovery is sputtering.
Of all the data points that did come out of China, you mentioned youth unemployment. There was, of course, second quarter GDP. There was also retail sales. What do you find most concerning and has the biggest potential impact on how businesses, multinational businesses, decide to engage with China?
I think all this discussion about the China slowdown is covering up a lot of risks that people have not recognized explicitly, which is that in order to do investment in China, you have to find information of where the opportunities are and how well that Western investment dollars will be welcome in those areas. Well, the sources of information, the private sector sources and the Sherpas that would guide you are no longer available to the private sector. The government has reorganized information in a way that it's become much more centralized and given out by the government itself. So essentially, the government is telling you where to put the money and what you might get out of the money. So you only get the official story. You're not going to get a private sector view.
I am curious, though. I mean, Bill, when we talk about some of the commentary out of the officials, meaning this is the official commentary coming out of them, they have flagged some concerns publicly, particularly about youth employment, as you just raised here. But I guess my question is, why haven't we seen more to address that here? I think anybody who understands the dynamics, the political dynamics of having a large unemployment base of young people, at least history has shown that doesn't end well.
No, it doesn't. And what we've seen is a charm offensive on the part of the officials to try to invite more Westerners to come there. And we've had a stream of U.S. And Western CEOs going to China saying, we're there to stay, and we're reassuring you that we are committed to China. So you get all these positive vibes from the sell side. But let's not forget, a lot of these sell side institutions, and my former one in particular, JP Morgan and Citibank, are there because their business model is to try to bring Western dollars to China. And so I would think that their incentives are not to tell you that there are some dangers for putting investments into China. And so I think we're not hearing enough about the risks. Whereas I think a lot of the people that we had talked to at Milken are saying, well, you know, if China isn't that investable anymore, maybe the rest of Asia would be the new opportunities. And I think that's where a lot of Western dollars are going.
Well, yeah, and we've certainly seen that. It's going to a lot of other Asian nations. Of course, India had its moment in the sun when Modi came to the U.S. And I think a lot of investors, if not necessarily wanting to turn their backs on China, certainly want to diversify in a way so they're not completely dependent on it. I guess then what does a Yellen visit like this mean? What does a Blinken visit like this mean here? Is there going to be a material improvement in the relationship between the U.S. and China where there is a broad net benefit to them economically?
Well, Romaine, I think what you've heard from Secretary Yellen is exactly what is going on, which is the basic fundamentals have not been addressed, and she can't speak for Trade Ambassador Tsai, but the trade negotiations about tariffs, which is what the Chinese want us to reduce, are not there. And I think the Chinese are so eager to talk to Secretary Raimondo of Commerce because they want her to say, hey, we want to develop chips in the United States, but we're going to bring China into the chip ecosystem. That's the kind of negotiation they want to hear, but I don't think they'll get it because they themselves have not really let down the barriers. And in fact, they've gone the other way. They said, we're going to create our own technologies. We're going to create our own AI. We're going to do our own standards for quantum computing.
And it's for that reason that so many U.S. and European investors and companies and governments are trying to actively de-risk from China, right? Reduce whatever economic vulnerabilities they have to the country without damaging trade or investment. To what extent is this having a material impact? Is this showing up in the weak data? Is that why the data is so weak that China can't get going from its post-COVID recovery?
Well, the global economy is slowing down because of the fight against inflation. So that's given. But I think what you're seeing is that the marginal investment dollar is reconsidering its location. It's reconsidering whether it should be going into China, following the previous dollars, or going somewhere else. And I think you're finding more of the dollars going somewhere else. And that, I think, is the thinking that a lot of Western investors are engaged in right now, which is to say we need to diversify our supply chains and our investment opportunities.
The dollars are going somewhere else. Are there fewer dollars going into China? Are dollars actively leaving China right now?
Well, the dollars leaving China are somewhat difficult to find, right? Because a lot of, for example, Taiwanese money that's invested in China, they go into China, but then they get reinvested into Vietnam and other places. So China actually is doing the right thing and diversifying its own production, its own supply chain, because it wants to move up the value-added chain. So that is part of their economic planning. So I think we have to sort of sit back a little bit and see where ultimately the final dollars go and where China is putting its emphasis on development and inviting Western money in. I think it's going to be in trying to create new standards for electric vehicles, create new standards for quantum computing. And if we can engage in those in a way that preserves our intellectual capital, but also allows us to enter the Chinese market, those will be win-win opportunities.
Bill, I want to get your thoughts here on some of the broader economic concerns globally with China, the second largest economy, at least based on what we know now, maybe softening, maybe even in decline. Janet Yellen, the exclusive interview we had with her on Bloomberg earlier today, she saw the ripple effects, but also said she doesn't think it would be enough to knock the U.S. off of its pivot here. How important of a factor is China to the rest of the world, the developed world?
Let's remember, China is the second largest economy. It's got a huge domestic market, and everyone wants to be able to have some opportunity for that. And China is also a vital part of the supply chain, both in terms of vital minerals, as we're discovering, but also they have technological developments that would help us. Their facial recognition is better than anybody else's out there, except, of course, if you want to find particular ethnic groups. One of the things that I think we need to recognize is that comparative advantage still works, but we need to work with comparative advantage by adding a couple of national safety concerns and a couple of other things that would diversify that supply chain. What we're working out now is a framework for trade for the 21st century, and that's the hard negotiations that's going on between our trade representatives, both in China and among the Europeans. The Europeans are much more dependent on China than we are in terms of manufacturing. Germany is highly dependent as an auto exporter to in the Chinese market.
So that's why there's a lot of questions as to how China will respond to the slowdown in its economy, whether it's going to take more steps to boost the economy. We know the strategy for the past decade is to transition away from investment and exports and towards consumption. What's stopping Beijing from taking steps such as offering direct subsidies to households?
Because the amount of fiscal space the Chinese government has is very limited. The debt load and the channels of fiscal transmission have often gone through the local governments. And local governments themselves are so indebted right now that they themselves cannot stimulate the economy without other sources of revenue other than selling land. And so I think the fiscal reforms that are needed to make fiscal policy more efficacious in China are still to be made. We at the IMF have been advocating these kind of fiscal reforms for some time, and they still haven't really done them. So China is very limited in how much stimulus it can create right now.
All right, Bill, always great to catch up with you. Bill Lee there, he's the chief economist over at the Milken Insitute.